India is currently executing the most aggressive capital expenditure cycle in its history, pouring trillions into national development. To capitalize on the massive scale of these ongoing projects, we have to look at the physical machinery actually building them. Action Construction Equipment, or ACE, serves as a direct proxy to this national development. They command over a 60% market share in the mobile crane sector. When you see a high-rise or a highway under construction, those lime green and orange cranes belong to them. Their revenue streams are heavily diversified beyond standard construction. They supply the heavy lifting required for the country's aggressive railway network expansions. They are also entrenched in high-barrier industries, producing specialized earth-moving equipment for open-pit mining operations and manufacturing heavy defense hardware. Because their order books are tied directly to multi-year government infrastructure commitments, the company's revenue floor remains stable even during broader market cycles. This fundamental stability forms our primary thesis before we ever look at a price chart. Yet, despite dominating the material handling market, ACE recently underwent a significant price correction from its historic highs. While retail traders often misinterpret these drawdowns as a reason to panic, institutional analysis approaches these corrections as an opportunity to hunt for specific technical signals, data points that distinguish a genuine collapse from a strategic re-entry point. To strip out the daily retail noise and track where this smart money is actually flowing, we have to analyze the structural footprint using the weekly timeframe chart on the NSE. Our objective now is to precisely deduce if the current consolidation near 932 rupees is random market fluctuation or a strictly defined institutional accumulation zone. Looking at the weekly price action, ACE is currently trading exactly at 932 rupees. Notice the aggressive rally that preceded this period. It was ultimately capped by a psychological ceiling at the 1,000 rupee mark. If we drop our focus down to the volume profile at the bottom of the structure, it reveals exactly what is happening during this recent pullback. These shrinking, desaturated bars indicate a severe contraction in trading activity. In technical terms, this is supply exhaustion. The intense selling pressure that drove the price down has evaporated. The fact that volume has dried up while the price holds its ground suggests that heavy selling pressure is finally being absorbed. This transition indicates that what looked like a chaotic decline is likely maturing into a structured accumulation base. To map long-term momentum, we apply the 20, 50, 100, and 200 period exponential moving averages directly to the price structure. These bands act as a filter. They separate structural, lasting market trends from temporary weekly volatility. The price action is demonstrably respecting these averages. We are observing the technical principle of polarity, where the asset successfully turns its old resistance ceiling into a durable, supportive floor. This precise confluence of moving averages provides strong evidence that institutional buyers are quietly absorbing the remaining floating supply at these levels. This brings us to execution. For those building a fresh position, the pocket strictly between 930 and 950 rupees serves as the primary entry zone. Securing an entry in this precise bracket aligns your risk-to-reward ratio, positioning you just before momentum potentially shifts back into the control of the bulls. However, external macroeconomic volatility is a constant. Professional execution requires scaling into a position rather than deploying all capital on a single entry point. To build a structural buffer, we define a secondary add-on dips territory resting exactly between 860 and 890 rupees. By dividing your allocation into a primary zone and a dip zone, you actively hedge against sudden market noise and secure an average price anchored in structural institutional support. Capital preservation must dictate the trade. No matter how perfect a technical projection looks, it is useless without a rigid exit protocol. Dropping down to the bottom of the structure, the critical swing low sits precisely at 820 rupees. This line serves as your absolute stop-loss limit, enforced strictly on a weekly closing basis. The logic here is straightforward. If the stock closes below this 820 rupee threshold, the current bullish EMA and volume thesis is invalidated. Defining this exact point of failure caps your downside exposure and gives you total psychological control over the rest of your execution. With the downside cleanly cut, we expect this macro-technical structure to fully mature over a timeline of 4 to 5 months. Our initial upside target sits exactly at the psychological barrier we mapped earlier, hitting at 1,000 rupees. Once the price action clears that initial ceiling, the technical airspace opens a path to our second target at 1,170 rupees. If historical momentum repeats through the next cycle, the project valuation could reach 1,320 rupees and beyond. When you weigh the rigidly capped downside risk against these calculated upside projections, the trade presents a massive mathematical asymmetry, mapping out a potential return of 30 to 40%. Action Construction Equipment offers a tight alignment of data. Its massive macroeconomic tailwinds closely match its rigidly coiled technical structure. Based on the observed supply exhaustion and durable moving average support, the objective technical rating here is a strong accumulate. This breakout geometry is backed by the physical, ongoing reality of India's heavy infrastructure pipeline. Track these specific accumulation zones and risk levels on your own monitors, and keep a close watch on this asset heading into the upcoming quarters. Relying on rigorous top-down analysis is how you separate emotional gambling from calculated market execution. Disclaimer: this video is purely for educational purposes and should not be construed as financial advice. Please consult a SEBI-registered financial advisor before executing any trades or putting your capital to work.